investors and traders, and welcome to the weekly market report. I'm AJMonte, Chief Market Strategist with Sticky Trades. And before we get to the charts, I'm just pointing out the 7-point trading checklist that we use here to analyze the charts and put our price targets out. Now, if you're a member of Sticky Trades, you have this checklist on your member page. All you have to do is go to your dashboard, click on that, and you'll be able to follow along. If you're not a member of Sticky Trades and would like to get a copy of this to keep on your desk or by your computer somewhere, then just go to stickytrades.com, check in with our automated help desk, which is at the bottom right corner, and you could just ask for the checklist and we will send that over to you. Now let's get to the charts. Today, DIA closed up a fraction of a percentage. However, if you look at the candle, we have a full-fledged pivot point there as I magnify that for you. In addition to that, we still have the volume increasing over these 6 green candles. I do believe that we're going to see a drop in volume Monday or Tuesday. So what I'm going to do there is put a volume forecast. And once we get that drop in volume, I think we're going to start pivoting lower. Now, I do have a lower price target down here. I have another lower price target down here. So short-term price target here at 365.10. Intermediate price target down here is going to be 355.58. And the longer term, which I think will happen probably by February, is 335.77. Now, that's going to be a big help for option traders who are looking to select the proper expiration date, especially those spread traders out there. So again, short-term target, downside 365.10 for the diamonds. Now, if we go to IWM, you're going to see that we blew through my upside target here. We have an upside target that was set last Friday at 188.54. We now have gapped up on Thursday. Yesterday we gapped up. Today we are very close to a bearish engulfing candle. It's not quite a bearish engulfing, but if we had closed any lower, it would have been. We do have the drop in volume there. Again, follow that trading checklist. The drop in volume on the way up is bearish, so that would be selected there. You would check off the bearish signal on your trading checklist if you're using that to do your own analysis. Now, there's also a gap below the market, so I'm being very conservative on this downside target here. For next week, I think we will go down to 192.94, and then we'll have to see what happens with these oscillators down here. One thing that I point out again on that trading checklist are divergences with the CCI. If you look right here, I look for overbought, oversold conditions, but I also talk quite a bit about divergences. And what we have here is a higher price high on IWM. You could obviously see that, but we have lower highs showing up on the CCI down there. So that's a negative divergence. I call that a bear flag. It's not a price pattern flag, but it is a bearish flag, a caution flag if you want to call it that. So again, to reiterate, downside target on IWM is going to be 192.94. Now let's move on to the Qs. If you were watching my midweek report, I did something that I rarely do, and I added another upside price target on the Qs at 404.80, and we had already hit the target from last Friday down here, and we did that by Wednesday. So being that that target was already hit, then I extended that upside target to 404.80. And today we closed just about 54 cents, 55 cents from that. And so now if you look, the oscillators are going down, but the volume is still going up. So what I'm going to do is put a downside target here at 397.82, but that is going to be contingent upon a drop in volume. Again, if you are following along with me, especially on the Wednesday rapid fire stock analysis session, volume is a very big indicator. It's an important indicator. It gives us the more or less a lead into what the strength of the up or down move is on the market. Now, again, for those who are following along, with the rapid fire session, we had 25 star favorites. Now, for those that don't know what a star favorite is if you go to that trading checklist, if you have a stock and all of the signals are racking up on the bearish side, then that would be a star favorite to the downside. If the buy signals are racking up one after the next, that would be a star favorite to the buy side. Last week we had 25 star favorites. On Wednesday, we had 25 star favorites out of 52 stocks I think we analyzed in that 1 hour. And already 13 of the 25 have already hit their targets. And a lot of times I do 5-part forecasts. So you can consider the Qs being more or less a 2-part forecast, because I'm looking for a drop in volume and then that would lead us to that target. So I'm anticipating the drop in volume is forecast number 1, then forecast number 2 would be that price target at 397.82. Moving on to the spiders. There we go, SPY, it's the S&P 500 ETF. We have already hit this upside target. We're now waiting for this downturn here to hit that downside target at 450.18. I'm going to put a horizontal line right there and keep that downside target in place with that green dotted line just like that. And what I'll do is I'll match it up so it is exactly the same price. So that is 450.18. If I go here, I'm going to make sure that that is 450.18 and match that exactly like I said. So it'll be easier to see the price target with that horizontal line. Now, SPY is, again, the S&P 500 ETF, and for the most part, this is inversely related to the VIX and vice versa. If you look at the VIX here, you're going to see that we do have some green candles showing up right there. Yesterday, we had a bullish engulfing. It's hard to see whether or not that's red or green, but it is red because it closed 1 penny below the opening price. So that is considered to be a red candle, although you can't see it. And when a green candle engulfs, or you could even say eclipses, the previous red candle, that is taken as bullish. So I'm keeping this upside target in place like I said I would last week at $18.11. Now finally, for you silver lovers out there, and I'm going to do one more with Bitcoin because we had a big request for this. SLV, if you're following along on my X posts, that's formerly known as Twitter, you know that I had my upside target here for silver set at 21.90. I had bought back all and more of my long position in silver at $20.95, and I made that very public on my profile page. I think silver could pull back just a little bit, but there's still a gap above the market that I'm looking forward to possibly selling 5 or 10% of my position. So we haven't missed on any of the silver trades. If you're interested in tracking my silver trades, and I do this intentionally to teach the followers how to read charts, just go to hashtag AJSLV trades and you'll be able to see that and follow along. I make it a point to put the post out before I actually make the trades because I'm trying my very best to give the public a chance to get in ahead of me. I don't want to be accused of pushing the markets around or using the audience to favor my own position. So I give the audience a chance to make a trade if they want to do that. For the rest, they just ghost or follow along with my trades. So again, I think we could see a little bit of a pullback and then a move back up to fill that gap upstairs. Now, if you look at Bitcoin, I'm going to put /BTC. This is very much a technically traded currency. It's a digital currency, obviously, but we have a downside pivot here. So I'm going to make a forecast of just a very slight downturn in Bitcoin, like I think silver and gold will do. And I'm putting a downside target on Bitcoin of $41,090 in the next couple of weeks. But keep an eye on that blue line, which is the 20-period moving average. That is something that will most likely act as a support level as it has in the past here, and even here. Now let's look at some of the economic news this week. The headlines were swamped with headlines that there's going to be 3 rate cuts in 2024. Well, I don't want to throw the wet blanket on that party, folks, but that was all hope speaking through the financial media. In fact, go to Market Watch, read this article, watch the video. Fed Chairman Powell did not say any of that. They did not say they're going to be cutting 3 times in 2024. In fact, if you do a little bit more research, you'll see Fed governors even disagreeing with one another on whether or not there'll even be rate cuts at all. So keep an eye on that. The market rallied on that news, and that's what I call hopium. And yes, it did rally. The markets reacted in a knee-jerk way, rallied up hard. I think we're going to see a continued attempt by the bulls to close right on the highs as we move into the Santa Claus rally, which is the last 5 days of this month and the first 2 trading days of next month. Now, next, keep an eye on this because this is recent news. Last week, the United Arab Emirates just stopped transacting oil in US dollars. I've been predicting this for over a year, and now the BRICS nations are in full control of most of the world's nuclear arsenals, oil, precious metals, and rare earth metals. I told you that this was being forecasted and even projected by the World Economic Forum. This is an attempt to crush the US dollar and more or less go to war with the U.S. without even firing a single shot. This is something you have to keep an eye on. This could very well bring back inflation like we've never seen before. If the dollar loses its status as the reserve global currency, then the Fed will absolutely not be able to cut rates. They'll have to raise rates to make the dollar more attractive. So again, you can't believe everything that you're seeing, hearing, or even reading. The other thing is we're reaching historic levels with regard to M2, the money supply. M2 has been decreasing at the fastest pace since the Great Depression. That is a fact. Go out there and check what's happening with the Federal Reserve. Go out and look at the reports that come out from the different departments that report on M2, M1, and such, and even the velocity of money. This, in my opinion, is not going to be good for anything because you can see here, the velocity of money shrinks or slows down when the money supply drops. And this is a report that came out from Bank of America Global Research. And I find most interesting is that when this report came out, Bank of America was on the financial networks talking about how great things are. And in the very same day they published this report, look what's happening. This is spending per household on holiday items. Normally you see this going up, especially in December. In fact, the reality is it's dropping like a rock. Why? Because people don't have any more room left on their credit cards. They don't have enough money to pay in cash. They're overextended in debt. I've been talking about this as well. And I'm telling you, folks, you can make money on the way up, even when the long-term outlook looks bearish. We are doing that in our equity trades. 95% of our trades have been long positions, and we've done well with those. In fact, 83% of our long positions went up after we put out the publications. And so you can make money on long positions, but I find it to be much safer to be cautious, trail your stops, protect your profits, and minimize any losses if positions go against you. That's been something I've been talking about every single day last week especially, and we have this embedded in our website, which is what we refer to as the 1% rule. Now, if you go on and look at what's happening here, we have Warren Buffett is moving more cash to the sidelines. He sold $28.7 billion in stocks, and this rings the alarm over the economy. Folks, I'm not following the Fed. I would much rather follow Warren Buffett, for sure. Now, if you look at what he's been doing, he's in record cash pile right now, $157 billion in cash. And this is another thing that I refer to with regard to cash, that is that cash is an opportunity waiting to happen on the downside. Warren Buffett and his team know exactly what they're doing. They continue to move to cash as the markets look more and more overextended each and every day. And that is what we're seeing there. Now, when I talk about the economy, you have to understand something. Use simple logic, folks. If everything was as great as the Treasury Secretary seems to think and other economists seem to think, then they would not have to lie about the economy. It would just be rip-roaring higher, and everyone would know about that. And I think each and every one of you who are listening to me right now know that something is just not right. right? You might be off to the right here like this fellow here is thinking, what's going on? And the fact is, if you look carefully at what has been reported over time, back in November of 2017, right, just a mere 5 years ago, we had 20 trillion in national debt, and Yellen was warning how this should keep people lying awake at night. With 20 trillion, now we're at 34 trillion. And how is it that all of a sudden Yellen isn't even losing any sleep over this? You see, this is an outright lie. And like I said before, using simple logic, if the economy was rip-roaring good, they wouldn't have to lie. The economy would be speaking for itself. In fact, these are a bunch of cheerleaders here trying to keep the markets inflated as we go into the presidential elections, because that looks good for Biden. Obviously, when the markets rallied this week, within hours, they were announcing how great Bidenomics was on the press conferences as soon as we were rallying up 500 points. You see how the cheerleaders tend to push the markets with their words, but unfortunately, there are a lot of people that react to that. Again, I'm not saying you can't take a long position, but you had better be very careful in keeping your stops in place, for sure. Now, here's some more of the danger signs. Again, what's the danger of having such high debt as a nation? Well, just read for yourself right there. I'll put a link to these articles down below in the description page so you could read along with me and follow along and keep your own notes. But just be really careful out there because the danger signs are everywhere. Coming out from Wharton, we have right here, this was a report that was published in October. When does federal debt reach unsustainable levels? Well, I'll tell you when it reaches unsustainable levels. We're at that point right now. Financial markets demand a higher interest rate to purchase government debt as the supply of that debt increases. So again, looking at this report, looking at the amount of debt that we're carrying, that doesn't ring very clear when I hear rumors or hopes that the Fed is going to reduce rates. They cannot do that, and everyone really needs to pay very close attention. So my goal, again, is each and every week teach people the charts so they could read and forecast for themselves. We pride ourselves here at Sticky Trades to be the educational go-to company where you can learn about options, trading, risk management, technical analysis, and more. Folks, have a great weekend, and I'll talk to you on the next report. So long.